All right, let's get right into it. Today, we're going on a quest, really, to answer one of the most fundamental questions in all of finance.
So what is a company really worth? This is so important because, the stock price you see flashing on your screen, that's not the same thing as its true value. There's a famous saying, price is what you pay, value is what you get. And that's what we're hunting for today.
And to figure out that true value, investors, well, they're basically on a hunt. They're looking for something called intrinsic value. You could almost call it the holy grail of investing, really.
So what is it? Just think of it like the treasure we're trying to find. It's what a stock is fundamentally worth when you look at everything. Its assets, its earnings, its future potential. And knowing this, it's everything. It helps you figure out if a stock is a total bargain, way overpriced, or maybe, just maybe, priced just right.
Okay, so how do we actually find it? Well, here's where it gets really interesting. There isn't just one magic formula. Nope. Instead, analysts use three main maps, if you will. Each one is a different path to try and find that treasure, and each gives you a totally unique perspective.
Let's jump into our first map. This one is all about the balance sheet. Basically, what a company physically owns.
The asset-based approach is pretty simple, right? The idea is that a company is basically worth the sum of all its parts. Like, if you could just sell off everything, the buildings, the trucks, all the inventory, and then pay off all the company's debts, what's left over? That's what it's worth to shareholders.
But, and this is a big but, which parts are we talking about? And more importantly, at what price? This is where things start to get a little tricky.
Yeah, this really highlights the main challenge here.
On one hand, you've got the historic cost. That's what the company paid for an asset way back when. Super easy to find, but it could be totally outdated. On the other hand, you have the net realizable value, what it would sell for today. Much more realistic for sure, but it's a lot harder to calculate. It's a bit of a guess.
And here's the biggest weakness of this asset-based map. It's got massive blind spots. It pretty much assumes a company is only worth its tangible stuff, the things you can touch. So it completely ignores all the valuable intangibles, like a killer brand, a great management team, or a super skilled workforce. And that's why it often gives you a kind of floor value, like what you'd get if the company just shut down and sold everything off.
Okay, let's move on to map number 2, the profit engine. This one shifts our focus completely. We're not looking at what a company owns anymore. Now, we're looking at how much money it makes.
Now, this one's a biggie. The income-based approach uses the famous price-to-earnings ratio, or PE ratio. You've probably heard this term thrown around a lot. It really just boils down to a company's earning power.
And the way it works is actually pretty simple. It's a 3-step process. Step 1, find the company's earnings per share, the EPS. Step 2, find a good P ratio, usually by looking at what similar companies are trading at. And step 3, you just multiply those two numbers together to get your intrinsic value.
Yep, that's the formula right there. Intrinsic value equals EPS times the PE ratio. This little equation basically tells us what the market might be willing to pay for every single dollar of a company's earnings. It's a powerful shortcut.
Let's make this real. Imagine a company with an EPS of, say, 20 cents. And let's say other companies in its industry have an average PE of 15. You just multiply 20 cents by 15, and boom, you get an estimated value of 3 ringgit per share.
All right, on to our third and final map. This one looks at cash payouts. We're shifting focus again. Forget assets on a balance sheet, forget earnings on paper. This is all about the cold, hard cash that an investor actually expects to get paid.
And this idea has been around for a long, long time. Back in 1938, a guy named John Williams said the price of a stock should just be the present value of all its future dividends. That's the core of the dividend valuation model.
But a heads up, this model isn't for everyone. It works best for those big, mature, stable companies that regularly pay out dividends to their shareholders. The ones that have been around forever. It's pretty much useless for a high-growth startup that's reinvesting every dollar it makes.
What's cool about this model, though, is that it can be adjusted based on how we think those dividends are going to grow. Are they going to stay the same forever? That's zero growth. Will they grow at a nice, steady pace? That's constant growth. Or will the growth rate change over time? That's differential growth. Each one has its own little twist.
So there you have it, our 3 maps. But here's the thing. Valuation is definitely not a science. As you've probably figured out, none of these maps gives you a single perfect answer. They're all based on assumptions. And that's why this is so tricky. It's as much an art as it is a science.
This chart really sums it up nicely.
You've got to know which map to use and when. The asset-based approach? It's best if you're thinking about a company shutting down. The income-based PE method? Perfect for comparing a company to its rivals. And the dividend-based model? That should go to for those reliable dividend-paying giants. The real skill is knowing their limits.
So, the crucial point is that skilled investors don't just pick one. They use a combination of these models to get a much clearer picture of a company's real value. No single map tells you the whole story. You have to put them all together to really see where you're going.
And really, that's what this is all about. A stock's price is what you pay. Its value is what you get. So after today, the big question for you is, how will you know if you're getting a good deal? Understanding these tools is the first step to answering that.